The global financial system just experienced something most people didn't notice. Over the past 18 months, China has reduced its holdings of United States Treasury securities by more than $600 billion. Not gradually, not quietly in the background. This was deliberate, systematic, and large enough to reshape the mechanics of how global debt markets function. If you hold assets denominated in dollars, if you have savings in traditional markets, or if you've been building a position in alternative stores of value, this shift changes the landscape you're operating in. Not tomorrow, not in some distant crisis, right now. Most financial news will frame this as political theater, as tension between two superpowers playing out in bond markets. That's the easy story, the comfortable story. But the reality is more structural, more fundamental, and ultimately more important for anyone trying to preserve wealth over the next decade. China isn't dumping US debt because of headlines or diplomatic friction. They're doing it because the incentives that made holding that debt attractive for 30 years have fundamentally reversed. And when incentives reverse at this scale, markets don't just adjust, they transform. Let me be clear about what this means for you. If you're someone who has been building a position in assets outside the traditional system, assets that benefit when confidence in centralized debt structures weakens, this is the macro backdrop you've been waiting for. Not because everything collapses overnight, but because the slow, grinding forces of currency debasement and debt saturation are now visible in the behavior of the largest foreign creditor to the United States. If you haven't yet positioned yourself, this is not a moment to panic or chase. It's a moment to understand what's actually happening beneath the surface, so you can make decisions based on structure rather than emotion. China has been the second largest holder of U.S. Treasury securities for decades. At its peak, they held over $1.3 trillion in American government debt. That wasn't charity, it wasn't friendship. It was a byproduct of trade surpluses, currency management, and a global system where dollars were the only game in town for settling international transactions. When China sold goods to the world, they accumulated dollars. Those dollars needed a home. U.S. Treasuries were considered the safest, most liquid option, so they bought, and they kept buying. For years, this arrangement worked for everyone. The United States funded its deficits cheaply. China parked its trade surplus safely. The system hummed along. But systems built on convenience eventually meet their limits. Over the last several years, the math behind that arrangement began to break down. U.S. inflation surged to levels not seen in 4 decades. The Federal Reserve, in response, raised interest rates faster than at any point in modern history. Suddenly, holding long-dated U.S. debt meant locking in negative real returns while watching the purchasing power of those dollars erode. At the same time, geopolitical relationships soured. Sanctions became a common tool. Asset freezes became a reality for certain nations. And China, watching what happened to Russia's foreign reserves, began asking a very rational question. If dollars can be frozen, if bonds can be leveraged as political tools, why hold so many of them? So they started selling. Not all at once, not in a way that crashes markets, but steadily, month after month, reducing their exposure to an asset that no longer made strategic or financial sense, from over $1 trillion down to just above $700 billion. $600 billion rotated out of the safest asset in the traditional system. That capital didn't disappear. It went somewhere. Some of it went into gold, some into other currencies, some into infrastructure, commodities, and strategic reserves. But the pattern is undeniable. The largest foreign holder of U.S. debt is actively diversifying away from it. Now, most people hear that and think it's a story about China. It's not. It's a story about incentives. It's a story about what happens when the asset that underpins the entire global financial system starts to lose its appeal, not because of a crash, but because the fundamentals that made it attractive have quietly eroded. And once that process begins, it doesn't reverse easily. You can't put the toothpaste back in the tube. You can't recreate trust in a system that weaponizes its own currency. Here's what most people misunderstand. They think if China sells U.S. debt, it means the dollar collapses tomorrow. That's not how it works. The dollar's still the global reserve currency. It's still the medium for most international trade. It's still deeply embedded in the infrastructure of global finance. But reserve currency status is not a light switch. It's a gradient. It erodes over time through 1,000 small decisions by central banks, corporations, and sovereign wealth funds, all of whom are quietly asking the same question China asked. What happens if the rules change? What happens if our dollars aren't safe? This is where disciplined investors start paying attention, not to headlines, not to predictions about when the dollar dies, but to observable behavior. When the largest players in the system start moving their pieces on the board, it tells you something about the board itself. It tells you the game has changed. And if you're still playing by the old rules, you're going to be caught off guard when the new rules become obvious to everyone else. Let's talk about what this means for inflation. The United States funds its deficit by issuing debt. For decades, foreign buyers, especially China and Japan, absorbed a huge portion of that debt. They provided consistent demand, which kept yields low and borrowing costs manageable. But when a major buyer steps away, someone else has to fill that gap. In practice, that someone has been the Federal Reserve and domestic institutions. But there's a limit to how much debt can be absorbed without consequence. When demand softens and supply keeps growing, yields rise. When yields rise, the cost of servicing existing debt increases. And when that happens, governments face a choice: cut spending, raise taxes, or print money to cover the gap. History shows us which option gets chosen. Printing money is the path of least resistance. It's politically easier, it doesn't require painful cuts or unpopular tax hikes. But it has a cost. That cost is inflation, not the kind of inflation that shows up immediately in a single month's data. The kind that grinds away at purchasing power over years, that shows up in the price of essentials, in the devaluation of savings, in the slow realization that the dollars you saved 5 years ago buy significantly less today. This is not speculation. This is observable reality. The United States national debt now exceeds $34 trillion. Interest payments on that debt are approaching $1 trillion per year. That's more than the defense budget, more than Medicare. The math is unsustainable and everyone in the system knows it. But the system doesn't collapse because the math is bad. It adjusts. It inflates. It quietly transfers wealth from savers to debtors, from those who hold cash to those who hold scarce assets. If you already hold assets that perform well in inflationary environments, this is your confirmation that the thesis is playing out. If you hold hard assets, real estate, commodities, or decentralized stores of value, the incentives are aligning in your favor. Not because of hype, but because the alternative, holding depreciating currency in a system built on ever-expanding debt, becomes less rational every quarter. This doesn't mean everything goes up in a straight line. It means the long-term trend favors scarcity over abundance, tangible over intangible, decentralized over centrally controlled. If you don't yet hold these assets, this is not the time to panic buy. This is the time to educate yourself, to understand why certain assets preserve value when trust in centralized systems weakens. It's the time to build a plan, to think in years rather than weeks, to recognize that positioning yourself for macro shifts requires patience and discipline, not speculation and leverage. Let's address what not to do, because this is where most people sabotage themselves. Do not react emotionally to this information. Do not assume this means the financial system collapses next month. Do not over-leverage yourself trying to catch a trade. Do not blindly follow influencers who promise you 10 times returns in 90 days. Do not abandon all traditional assets in a fit of panic. And most importantly, do not assume you can time this perfectly. Markets are messy. Macro trends take years to fully play out. There will be rallies in traditional assets. There will be corrections in alternative assets. There will be moments when it feels like nothing is working. But if you understand the underlying forces, if you recognize that debt saturation and currency debasement are structural problems without easy solutions, you can position yourself thoughtfully rather than reactively. One of the most important concepts in finance is understanding cycles. Markets move in waves. Confidence builds, then breaks. Capital flows into certain assets, then rotates out. What feels permanent in the moment is often just a phase in a longer cycle. Right now, we are in a phase where confidence in the traditional debt-based system is quietly eroding. Not collapsing, eroding. And in that erosion, opportunities emerge for those who recognize the shift early. Think about what happened in the 1970s. The United States left the gold standard. Inflation surged. Traditional assets struggled. But those who held gold, commodities, and real assets did well. Not because they predicted the exact timing, but because they understood the macro environment and positioned accordingly. We are in a similar structural shift now. The tools are different. The assets are different. But the underlying dynamic is the same. A system built on debt and currency expansion eventually reaches a point where the incentives to hold that currency weaken. China's actions are a signal. They're not the whole story, but they're an important part of it. When a rational actor with over $1 trillion in reserves starts moving away from the safest asset in the traditional system, it tells you something about how they view risk. It tells you they see better alternatives. And if they see better alternatives, maybe you should be looking at those alternatives too. This is also about sovereignty. For decades, holding US dollars and US debt was the only way to participate in global trade at scale. But as technology evolves, as alternative settlement systems develop, as central banks diversify their reserves, that monopoly weakens. It doesn't disappear, but it weakens. And in that weakening, space opens up for assets that don't rely on centralized control, that can't be frozen or weaponized, that exist outside the traditional banking system. I'm not telling you what to buy, I'm telling you what to think about. If you're building wealth for the long term, you need to ask yourself what preserves value when currency debasement is a feature, not a bug. You need to ask what happens to your savings if inflation averages 5 to 7% for the next decade instead of 2%. You need to ask what assets benefit when trust in centralized institutions erodes. For those who already hold these assets, the current environment is validating. You're not early, you're not late, you're positioned. But that doesn't mean you stop learning, stop adjusting, stop thinking critically. Markets reward those who stay curious, who update their models when new information arrives, who manage risk intelligently rather than assuming they're always right. For those who don't yet hold these assets, the opportunity is still there. But it requires homework. It requires understanding why scarcity matters, why decentralization matters, why long-term thinking beats short-term speculation. It requires resisting the urge to chase green candles and instead building conviction through education and patience. One more thing to understand. The system we've lived under for the past 50 years, the post-Bretton Woods fiat currency system, was an experiment. It allowed unprecedented expansion of credit, unprecedented government spending, unprecedented financialization of the economy. And for a long time it worked. But experiments have endpoints. They reach natural limits. We may be approaching one of those limits. Not in a catastrophic sense, but in the sense that the rules are changing, the incentives are shifting, and those who adapt early will fare better than those who cling to old assumptions. China reducing its treasury holdings is not an isolated event. It's part of a larger pattern. Central banks globally are buying gold at record rates. Emerging economies are exploring alternative payment systems. Corporations are adding hard assets to their balance sheets. Individuals are seeking stores of value outside the banking system. All of this points in the same direction. A slow, grinding shift away from pure dependence on fiat currency and centralized debt. This doesn't mean the dollar disappears. It means the dollar's dominance weakens. It means alternatives gain legitimacy. It means the world becomes multipolar in terms of reserve assets, rather than unipolar. And in that transition, volatility is inevitable. Uncertainty is inevitable. But so is opportunity for those who understand what's happening and position themselves accordingly. Let me ground this in something practical. If you're watching this video, you're probably someone who thinks independently. You're probably someone who doesn't just accept the mainstream narrative. You're probably someone who values understanding over being told what to think. That's good. That mindset is essential in moments like this, because the mainstream narrative will tell you everything is fine, that central banks have it under control, that markets always recover, that you should just keep doing what you've always done. But when the largest foreign creditor to the United States is quietly exiting their position, when inflation remains stubbornly high despite aggressive rate hikes, when government debt grows faster than the economy, maybe everything isn't fine. Maybe the system is under more stress than the headlines admit. And maybe, just maybe, it's worth thinking differently about how you preserve and grow wealth in this environment. I'm not saying abandon everything. I'm not saying go all in on any single asset. I'm saying diversify intelligently. Think in terms of probabilities, not certainties. Recognize that the next decade may not look like the last decade. Understand that the forces reshaping global finance are structural, not cyclical, and position yourself in a way that protects you if those forces continue to play out as they have been. This is also about emotional discipline. The hardest part of investing is not finding good ideas. It's sticking with them when they're not working in the short term. It's ignoring noise when everyone around you is panicking or euphoric. It's trusting your process when the outcome is uncertain. If you build a thesis based on sound reasoning, if you understand the macro environment, if you manage risk intelligently, you can weather volatility without making destructive decisions. Right now, we're in a period where patience is being tested. Markets are choppy. Narratives shift weekly. News cycles create noise that drowns out signal. But beneath all that noise, the fundamentals remain. Debt is growing. Currency is being debased. Trust in centralized institutions is eroding. And alternatives are gaining legitimacy. Those fundamentals don't change because of a single headline or a single month of data. They change over years through consistent observable behavior. So where does this leave you? If you're someone who has been paying attention, who has been building a position in scarce assets, who understands the difference between sound money and inflated currency, you're exactly where you need to be. Keep learning, keep adjusting, keep managing risk. But don't second guess the thesis because of short-term volatility. If you're someone who is just starting to understand this, welcome. You're not too late. You're early in the context of how long this trend will take to fully play out. But don't rush. Don't overcommit capital you can't afford to lose. Don't assume you need to go all in today. Build slowly, educate yourself deeply, understand what you own and why you own it. That foundation will serve you far better than trying to time the perfect entry. And if you're someone who still thinks none of this matters, and that the system will muddle through as it always has, that's fine. But at least understand the risks you're taking by staying fully invested in depreciating assets. At least recognize that the world's largest creditor nation disagrees with you, and they're voting with hundreds of billions of dollars. The crisis isn't coming. The crisis is here, not in the form of a dramatic collapse, but in the form of a slow, relentless transfer of wealth, from those who hold depreciating currency to those who hold scarce assets. It's happening in grocery stores and housing markets and the cost of healthcare and education. It's happening in the balance sheets of central banks and the reserve allocations of sovereign wealth funds. It's happening in the decisions of rational actors like China, who are quietly exiting a system that no longer serves their interests. You can choose to see this, or you can choose to ignore it, but you can't choose the consequences of ignoring it. The macro environment is shifting, the incentives are changing, and those who adapt will preserve wealth, while those who cling to old assumptions will watch their purchasing power erode year after year. This is not about fear, this is about clarity. It's about understanding the forces shaping the financial landscape and making informed decisions based on that understanding. It's about recognizing that the rules of the game have changed, even if most people haven't noticed yet. And it's about positioning yourself intelligently, patiently, and thoughtfully for what comes next. Stay informed, stay disciplined, stay focused on long-term fundamentals rather than short-term noise. Understand cycles, manage risk, and above all, think for yourself. The answers won't come from headlines or influencers or predictions. They'll come from your own understanding of how money works, how markets work, and how human behavior works under pressure. The path forward requires patience, education, and emotional control. It requires resisting the urge to react to every piece of news and instead building conviction through deep understanding. It requires recognizing that wealth preservation in an era of currency debasement is not about hitting home runs. It's about not striking out. It's about making fewer mistakes than the crowd, thinking longer term than the crowd, and staying rational when the crowd is driven by fear or greed. China just showed you their hand. They're rotating out of dollars and into alternatives. The question is not whether that matters. The question is what you're going to do with that information. Are you going to pretend it's just noise? Or are you going to recognize it as a signal, adjust your thinking, and position yourself for a world where the old certainties no longer hold? The choice is yours. But the data is clear. The trend is clear, and the opportunity for those who see it clearly is significant. Not guaranteed, not without risk, but significant. And in a world where most people are sleepwalking into currency debasement, simply being aware and positioned differently is a form of asymmetric advantage. This is the moment. Not the moment to panic, not the moment to speculate recklessly, but the moment to understand what's happening, to think critically about your own position, and to make decisions that serve your long-term interests rather than your short-term emotions. The macro backdrop is shifting. The largest players are moving. And the question is whether you're going to move with them or wait until the shift is so obvious that all the advantageous positioning is already taken. Stay thoughtful, stay disciplined, and keep learning. Because understanding these cycles, understanding how capital flows and why incentives change, is the most valuable skill you can develop as an investor. Not predicting the future, understanding the present, and positioning yourself intelligently based on that understanding. That's how wealth is preserved. That's how opportunity is captured. And that's how you navigate uncertainty without losing yourself to fear or greed. What we can know is that the path of least resistance for policymakers is inflation. We can know that tangible assets have historically preserved purchasing power during inflationary periods. We can know that the current debt levels are unsustainable at normalized interest rates. We can know that central banks are trapped and that their options are limited. These are not predictions. These are observations based on math, on history, on the incentive structures that drive policy decisions. And based on those observations, having exposure to tangible assets, including silver, makes sense. Not as a speculation, not as a bet, but as a rational response to an irrational monetary system. So whether you already hold silver or you're considering it for the first time, approach it with that framework. Approach it as someone who understands the game being played, who sees the big picture, who isn't swayed by daily noise or short-term volatility. Stay informed, stay disciplined, stay humble. And remember that the goal is not to outsmart the market, but to position yourself sensibly for a range of outcomes, understanding that the future is uncertain, but that preparation matters. What happened in Asia overnight is a signal. It's a reminder that the world is changing, that the monetary system is under stress, that capital is flowing into tangible assets for reasons that go far beyond speculation. Pay attention to that signal, understand what it means, and act accordingly with the wisdom and discipline that separate thoughtful investors from the crowd.